Good evening, students. Welcome to the session. So, have you revised? In the last class, we had done the tax rate on the capital gain. We are although left with some portion of the capital gain as yet, which we are going to discuss in today's class, and then we will be starting up with the income from other sources. So, I just wanted to ask you if you have any questions concerning the last class. Good evening, Oja. Yes? Okay. So, if there are no questions concerning the last class, start with this particular lecture. Now, if you remember in the earlier class, we were discussing about the tax rates on the capital gain, wherein I had done or I had started with the long-term capital gain on the other than 112A. So if you see, we have done this particular chart, which was before 23rd July and after 23rd July. We have seen with different kind of assessees and different kind of capital asset, what would be the tax rate, right? And now I will be talking about the 112A. So just quickly write down. Section 112A. Now 112A also has undergone some amount of amendment. That is what we are going to discuss today. Now in 112A, this is applicable on the listed equity shares, equity oriented funds which are listed, and third on the units of the business trust. Now this particularly requires one important condition as the payment of the STT. So you need to or you should have paid the security transaction tax as a part of the purchase and sale on the listed equity shares and on the sale in the case of the equity oriented fund. So let's write down over here to which assets 112A is being applicable. So first is listed equity share, right? The second one is the equity oriented mutual fund, right? What is an equity oriented mutual fund, students? We had seen this in the last to last class that there are two kinds of mutual fund, equity oriented and debt oriented mutual fund. So what is an equity oriented mutual fund? Yes, I have already discussed about this. What is an equity oriented mutual fund, students? Yes, someone has to answer to me. What is an equity oriented mutual fund? Yes.
Equity or mutual fund means when a mutual fund invested in the equity more than 65% in the equity shares, and if the mutual fund mutual fund invested in another mutual fund, the 90 percentage of its
Yes. So whether it was 65%, the answer is yes. So equity oriented mutual fund, if you remember, we have discussed while we were discussing about section 50. 50, yes, which section was it? What was the subsection? Market linked debenture, 50 double A, right? So
Yes.
I was telling you that point in time that if the units of the specified mutual fund and the market linked debentures or unlisted bond or unlisted debentures are sold after 23rd July 2024. Right? So in that case, if the units of the specified mutual fund on or after 1/4/23, market linked debentures and the unlisted debentures after 23rd July 2024, if these are sold, then the gains will be deemed to be the short-term capital gain. Now, what are the specified mutual funds? A mutual fund which invests greater than equal to 65% of total proceeds in debt and money market instruments. Right? This is a specified mutual fund. or a mutual fund which invests more than 65% of total proceeds in units of another mutual fund, which will then invest more than 65% in the debt or money market instrument. And there I had discussed with you what is equity oriented fund. So equity oriented fund, as you rightly pointed out, Roja, it is investing more than 65% of total proceeds in the listed equity shares, or a mutual fund investing in another listed mutual fund which invests more than 90% of its total proceeds, which invest more than 90% of the total proceeds in the equity shares of the domestic company. Sorry, minimum, 90% of total proceeds in such another fund, and such fund then invests 90% of its total proceeds in the equity share. Yes?
Yes.
So therefore, here I think we should just write down greater than 90% of total proceeds in another fund. Right? And then that listed in another fund which is listed on the recognized stock exchange. And that listed mutual fund will then invest 90% of its proceeds in the listed equity shares. So if these conditions are satisfied, then it will be called as the equity oriented fund. And that's where I told you the taxation will be under 112A. So this we have already done, isn't it, students? So see, this is how the linkage has to be established, right? So now you're just to write down under 112A, equity oriented mutual fund. And number 3 is units of the business trust. Right? So under 112A, which 3 assets are covered? Listed equity shares, equity oriented mutual fund, which is listed, and the third one is the units of the business trust. Are we clear? Now, once you satisfy these 3 asset conditions which is there, so therefore 112A will become automatically applicable. But here, what are the additional conditions with respect to the 112A? The condition is that on the listed equity share, you should have paid the STT at the time of purchase plus at the time of the transfer. So on the listed equity share, I should have paid the STT, you can just write down over here, at the time of purchase plus at the time of transfer. Right? Whereas for the equity oriented mutual fund and the units of the business trust, you should have paid the STT at the time of transfer. So on the equity share, both on the purchase as well as transfer, whereas on the equity oriented fund or the units of business trust, you should have paid the STT at the time of the transfer. Then if these conditions are satisfied and the capital gain is arising from the transfer of the long-term capital asset, so there is the capital gain arising on the transfer of a long-term capital asset, which is either of these 3 assets. Then in that particular case, what shall be my tax liability? So this has undergone the change. So prior to 23rd July 2024, if my date of transfer is prior to 23rd July 2024, then my tax rate earlier used to be 10% over rupees on the LTCG greater than rupees 1 lakh. Right? So prior to 23rd July 2024, my long-term capital gain, sorry, 1.25 lakh, not 1 lakh, it should be 1.25 lakh. So if I have the long-term capital gains arising on the transfer taking place prior to 23rd July 2024, then on the long-term capital gain exceeding rupees 1.25 lakh, on that amount the tax rate was 10%. Now post 23rd July, so on or after 23rd July 2024, if my long-term capital gain is exceeding 1.25 lakh, then my tax rate becomes 12.5%. So now my tax rate will become 12.5%. Under 112, this is 112A. I'm talking about under 112 also. If you look at that, under 112 also, we have considered now 12.5% only. See, under 112A, earlier it was 10%. And under 112, it used to be 10 or 20%. Isn't it? But post 23rd July, wherever the transfers are taking place, so where the transfer takes place after 23rd July, under 112 also, if you see in the case of the resident individual or HUF, it was 12.5%. Right? Only in the case where the land and building is acquired before 23rd July 2024, only in the case where the land and building is acquired before 23rd July 2024, you have an option to go with 12.5 without indexation or 20% with indexation in case of resident individual or HUF. Then in case of domestic company, again it has become 12.5%. In case of non-resident or foreign company, it used to be earlier 10% without the indexation. Right? Now, even they have said again here it will be 12.5%. Again they have said it will be 12.5%. In case of any other resident, again it is 12.5%. So, the maximum long-term capital gain has now been stabilized all across 112 and 112A. Earlier, you used to remember whether it would be 10%, it will be 12.5% or 20%, what it would be. Now it is directly flat 12.5% on the transfers post 23rd July. And the threshold is also increased in respect of the 112A, which was earlier used to be 1 lakh, now it is 1.25. Now just remember here one thing, students. With respect to this threshold which is given of 1.25 lakh, with respect to the threshold which is given of 1.25 lakh under 112A, this is a combined threshold on both the capital gain which is occurring prior to 23rd July and post 23rd July. So you don't have a separate threshold for prior and post 23rd July. So the total threshold which is available or the total exemption as we may call it shall not exceed 1.25 lakh on the transfers both prior and post 23rd July. So this you have to remember. You don't have a separate threshold of 1.25 for both on or after. Sorry, prior and after. You have a combined threshold of 1.25 lakh. So let's say, for example, if my asset is transferred, or let's say I'll write here, let's say a listed equity share is transferred on 1st June, where the long-term capital gain is, let's say, 1 lakh, right? And then listed equity share is transferred on 1st October, where the long-term capital gain was, let's say, 4 lakh. Now, it is not the case that you will apply this, you will exempt this entire 1 lakh, and again, you will reduce from here also 1.25 lakh. No. There will be a combined threshold which will be applicable of 1.25 lakh. Are we getting this? So a combined threshold of 1.25 lakh will be applicable. So this 1 lakh will get exempt. And out of here, you can exempt 0.25 lakh only. So then 3.75 lakh should be taxable at the rate of 12.5%. Are we getting this? But here, students, remember one very, very important thing. Here it is not mentioned that you have to apply the threshold necessarily only for the first item. And then the balance you have to apply for the second item. It is not mentioned anywhere like this. Nowhere the act says कि आपको पहले 1.25 lakh you have to apply for prior to 23rd July and the balance only you can utilize post 23rd July. So that means students understand this point very, very carefully. See, that means students, I can apply entire 1.25 lakh towards this 4 lakh. And instead, I can tax 1 lakh at the rate 10%. Why? Because iska tax rate is lesser than the tax rate on this. Now it is taxed at 12.5%, isn't it? So I can take this at the rate of 10% and I can reduce 1.25 lakh from 4 lakh, which will make it to 2.75 lakh, and I will tax 2.75 lakh at 12.5%. We can do that because the tax rate is now higher. So obviously I will choose to reduce that amount more. That's a normal wisdom, isn't it? So I can do that. Nowhere the act says that you have to reduce first from the prior and then only you will reduce it from the post 23rd July. It is not mentioned anything of that sort. Are we clear? Any questions so far? Yes? Any doubt, any question? Is this clear? Yes, Tariq? You have answered rightly about the equity shares. Okay.
मैम
Yes.
एक्चुअली मैं पहले तो ये अभी मेरा ये क्लियर हो गया 1.2 लाख का प्रायर जो आपने लिखा था. एक्चुअली मैं 1 लाख से थोड़ा कंफ्यूज हो रही थी. बट you have written the units of business trust and 112A is capital arising from long term capital asset and it is also covered in 50AA.
It is also covered in
50AA मार्केट लिंक्ड वहां पे भी ये कवर हुआ था ना यूनिट्स ऑफ
No. Units of business trust was not there under 50AA. So if you see 50AA was only covering the market linked debenture, unlisted bonds or debentures, and the specified mutual funds.
ओके यानी बिजनेस ट्रस्ट लिस्टेड है.
Yes, units of business trust are listed.
अनलिस्टेड था. ओके.
Yes, this is only unlisted bonds or debentures, market linked debentures, and the units of specified mutual fund under 50AA. Okay. Yes. Any other questions, students? Okay. Now, under 112A, as I said, the two condition is that in case of the equity share, the STT should have been paid at the time of purchase plus at the time of transfer. And in case of units of equity oriented fund or the units of business trust, it is at the time of only transfer. But there is one exception which is there. Now, what is that exception? So, in certain transactions, the CBDT has given a notification. In certain transactions, even where the STT is not paid, central government has issued a notification that in certain transactions, even where the STT is not paid, still it would be considered as exempt. Still it would be, covered by the 112. It will not be the case on those transactions, if you have not paid the STT, we will not cover by 112. It is not going to be like that. So, you can just write here. Exceptions. The transactions notified by the central government are still covered under 112A despite the fact that the STT is not paid on the purchase. And secondly, in the case where the units are located, where the transfer has been undertaken on a recognized stock exchange in any IFSC and where the consideration is received in the foreign currency. So in a case where the transaction has been undertaken on IFSC and the consideration is paid in foreign currency. In that case also STT is not applicable on IFSC. STT is not applicable on the recognized stock exchange in IFSC. So when you undertake the share transfer in IFSC, there is no STT there. So does that mean you come out of 112A? Answer is no. So you will still be falling under 112A because that is an exception. So where the transaction has been undertaken on the recognized stock exchange in IFSC and where the consideration is paid in forex. So with these exceptions, this means that these transactions are covered under section 112A despite STT is not paid. Are we clear? So these are the exceptions which are given where it is allowed that even if the STT is not paid, still it would be covered under 112A. You will not come out of 112. Are we clear? Now, what are the transactions which are covered in the notification issued by the central government? What are the transactions which are covered? We have to understand. So the central government has identified few transactions which are genuinely on which the STT is not applicable. For example, where the acquisition of the listed equity share is in accordance with the scheme which is approved by the court. For example, by the National Company Law Tribunal, by the Supreme Court, High Court, or by RBI or by SEBI. So there are these cases where, for example, in the case of mergers, in the case of the amalgamation, demerger, where the shares are issued, right, in consideration of the amalgamation which is happening. There, the amalgamation is approved by the court, without which you cannot undertake the amalgamation, right? Under the company law, you have to obtain the approval from the court. So in those cases where the shares are issued to the shareholders of the amalgamating company or the demerged company, right? We saw that. So in those cases, you will not be doing or undertaking the transaction through the recognized stock exchange. So obviously there will not be any STT paid. So, but when you will sell the share at that point in time, it will be a listed share. And at that time, the STT will be paid. So STT may not be paid at the time of acquiring the share. So therefore, in that case, it is a covered transaction. So CBDT has covered that transaction. Or if the shares are issued in accordance with the FDI regulations, or the preferential issue is made, right? Then in that particular case, even if the STT is not paid on those transactions, it is fine. Or for example, if the ESOPs are issued, when the ESOPs are issued again at that time, the STT is not applicable. Or for that matter, if the shares are given as gift, or you have the shares being contributed by a partner to the firm, which is taxed under 45(3), right? There also the STT may not have been paid. Or in the slump sale, when the shares are given. Or when the partnership firm gives, let's say, to shares to the partner on dissolution, 45(4). In these cases, the STT may not have been paid. So even if the STT is not paid, that is fine. These are still the covered transactions. So you can just write down over here. For example, gift, ESOPs, bonus shares, 45(3), 45(4), amalgamation, slump sale, demerger, right? All of these kind of transactions. Clear? So even if the STT is not paid in these transactions, that is fine. Now, here you have to remember, as a part of 112 or 112A, in both the cases, Chapter 6A deduction is not available. You will not be able to claim any Chapter 6A deduction against the capital gains, long-term capital gains, which are taxed either under 112 or under 112A. So you will not be able to claim the Chapter 6A deduction. So just write down, no Chapter 6A deduction can be claimed. Are we clear? Even on the case of 112, you have to write down, or you can write here itself, no Chapter 6A deduction can be claimed. Yes, are we clear about this? Now, as far as the basic exemption limit is concerned, the unutilized basic exemption limit. So, if you remember, I told you in the case of resident individual or HUF under 112, you can claim the unutilized basic exemption limit. Isn't it? You can claim the unutilized basic exemption limit. Even under 112A, you can claim the unutilized basic exemption limit. What do we mean by the unutilized basic exemption limit? So let's say, for example, let's take an example over here. Let's say my capital gain is, let's say, rupees 3 lakh under 112A. And let's say I have an interest of rupees 1 lakh. Let's say the basic exemption limit which is applicable to me is, let's say, rupees 2.5 lakh, let's say, as per old scheme. Right? Let's assume for a moment we are opting as per old scheme. So out of this 3 lakh, what I will do is, so out of this 2.5 lakh, 1 lakh will be used towards the interest. Right? So there is an unutilized basic exemption limit of 1.5 lakh still. I will use this towards the LPCG. So, first of all, how much LPCG is taxable? So, rupees 3 lakh minus rupees 1.5 lakh. Right? Rupees 3 lakh minus rupees 1.25 lakh, which will be 2.75 lakh. Out of this 2.75 lakh, I will reduce the unutilized basic exemption limit of 1.5 lakh. Are we getting that? So, the balance capital gain which is there, which is in our case will be 2.75 minus 1.5. How much that comes to? So 2.75 minus 1.5, 1.25 lakh will only be taxable as the long-term capital. Is this clear? Secondly, here you cannot claim rebate under 87A. So no rebate under 87A will be available to you. Yes, so where you have a rebate available, but here in this case you will not claim the rebate. Also, this unutilized basic exemption limit which is there, you can write here, only a resident individual or HUF can claim the unutilized basic exemption limit. Clear? Further, you will not be able to claim here the benefit of indexation or the foreign exchange fluctuation benefit. So here you will not be able to claim the benefit of the first or the second proviso to section 48. Are we clear? So just write down here. No benefit of first and second proviso to section 48. Are we clear? Yes or no? Is 1128 clear to you? Yes. Any questions so far? Any doubts, students? Yes or no? Yes. So just quickly recapping here, which kind of asset is covered? The equity share in a company, or the unit of the equity oriented fund, or the units of the business trust. On the equity share, you should have paid the STT on the acquisition and the transfer of such capital asset. If you are exempted by the central government notification, then even if you have not paid the STT on the acquisition, that's fine. But you should be covered by that notification. What are the examples? Gift, dissolution, shares given on the admission of the partner, then bonus shares, ESOPs, all of these examples where STT is genuinely not. Then in the case of unit of equity oriented fund or the unit of business trust, the STT should have been paid at the transfer of the capital asset. Are we clear? So then in that particular case, there is again another exemption if the transfer is taking place on the recognized stock exchange in the IFSC and the consideration is received in the foreign currency. If that condition is satisfied, then the long-term capital gain exceeding 1.25 lakh will be taxed at the rate of 10% if the transfer takes place before 23rd July. And if it takes place after 23rd July, then it will be at 12.5%. Are we clear? In case of the individual or HUF who is a resident, you will get the unutilized basic exemption limit. No Chapter 6A, no rebate under 87. Yes, any questions so far? Any doubts so far with respect to this? Yes or no? Are we clear? Okay. Now this is with respect to the long-term capital gain under 112A. And as I told you students, In case, let's say for example, 112A is not applicable to me. Let's say I'm not covered by central government notification and I have not paid the STT on the purchase, because let's say I have not bought the equity shares through the recognized stock exchange, I'm not even covered by the notification of central government, then in that case 112A will not be applicable to me. In that case 112 will be applicable to me. So then I will go back to 112. In case where the 112A is not applicable, you will tax as per 112, because for long term, it's only either of the two that you have the applicable. Alright? Yes or no? Okay. Now, here under 112A, how do you calculate the capital gain? Here there is something to be noted in respect of the cost of acquisition. So, here capital gain is as simple as I said in the section 48 when we were doing it. Right? What did I tell you? That in case of the 112A transfers, the first and the second proviso both are not applicable. Right? Now, when the first and the second proviso is not applicable, what you will take the cost of acquisition, students? Yes. What will be my cost of acquisition? It will be the actual cost paid, right? It will be the actual cost paid. However, this 112A which was there, this was introduced in 2018. Right, this was introduced in 2018. Prior to 2018, the long-term capital gain used to be entirely exempt. So there used to be an exemption under 1038 prior to 2018. So in order to protect the investments which were made prior to 2018, they provided a grandfathering benefit. Grandfathering is basically to protect the past investments. Just like if you see prior to 23rd July also, they are saying that the old tax rates will be applicable. So similarly, when the long-term capital gain tax rate was introduced prior to 31st January 2018, the capital gain which was there was exempt. So to protect the assets, to protect the equity shares or equity-oriented funds or business trusts which were acquired prior to 31st January 2018, in terms of cost, they have given certain benefit. Now, what is this benefit which is given? So, in this case, they are saying, Section 55 says that the cost of acquisition will be divided into two parts with respect to the specified assets which are covered under 112A. So what will be the cost? Cost of acquisition of the asset under section, or you can just write covered under section 112A. If acquired prior to 31st January 2008. Now, if I'm acquiring these assets prior to 31st January 2018, then I have to use this particular formula, or you may say the mode of computation or the cost which is given under section 55 of the Act. What 55 of the Act says with respect to the 112A, it says it shall be the higher of A, the cost of acquisition, the actual cost which is paid, or the lower of fair market value as on 31st January 2008. So FMV of the asset as on 31st January 2018 or the sale consideration, and the higher of these two amounts. So first you will identify what is the lower of the FMV as on 31st Jan 2018 and the sale consideration. And then you will compare it with the cost of acquisition to see what is higher of A or B. FMV here means where the capital asset is listed on a recognized stock exchange, then it is the highest price of the capital asset quoted on the recognized stock exchange. In case of the unit of mutual fund which is there, which is not listed on recognized stock exchange as on, let's say, 31st January, it will be the net asset value. In case of the equity share which is not listed on the recognized stock exchange as on 31st January, but listed on the date of the transfer, then you will use the cost inflation index. Are we clear? So these are the cases where the FMV is to be taken if the asset is acquired prior to 31st January 2008. Yes, is this clear? If it is post 31st January 18 or post 1st February 2018, then the cost of acquisition will be my normal cost. Yes or no? Is this clear? Any questions? Any doubt? Yes. Yes or no? Fast. Online students, Zoom students, is that clear? Absolutely. Okay, so this is 112A. Now, in case of the 112A, as I said, you have to be careful as to see that whether the STT is paid or not. If not, then it should be covered by the central government notification. What is the period of holding for these long-term capital assets? It is 12 months. What is the period of holding of the units of business trust? Yes, tell me. We have already discussed it. For the equity shares, the period of holding is 12 months. What is the period of holding for the units of the equity-oriented fund and for the business trust? Yes.
Ma'am, it is also 12 months.
For the equity-oriented mutual fund. And what about the units of business trust?
Ma'am, after this 23rd of July, it is also covered in the 12-month series.
But what was before 23rd July?
36 months.
Correct. So you have to remember that before 23rd July for the units of business trust, it was 36 months, and post 23rd July, it is 12 months. Now it is 12 months, but prior to 23rd July for the units of the business trust, it used to be 36 months. But for equity shares and equity-oriented mutual fund, it is same. So if you see here, we have also written, I think somewhere, listed units of the business trust. It used to be 36 months prior to 23rd July, and now it is going to be 12 months. So this is prior to 23rd July, and this is post 23rd July. Clear? Now coming to the short-term capital gain. Short-term capital gain is covered under which section? Which is a section for that?
Triple one A.
Yes, 111A is there, and then other than that, there is a normal rate of tax. Now coming to the 111A, first we'll discuss quickly that 111A is not that complicated as the 112 and 112A, but again there also we have a change. So let's write down for the 111A first. Yeah. So STCG 111A. Now what is covered under 111A? Under 111A, again we have the equity share or the units of the equity-oriented mutual fund or the units of the business trust. So all of the three are covered over here under the STCG if there is a capital gain arising on the transfer of a short-term capital asset, right? On the transfer of the short-term capital asset, which is listed equity share, units of equity oriented mutual fund, and units of the business trust. Are we clear? And in that particular case, the STT is paid on the transfers. Here there is no condition like, it should have been paid on the purchase also. But here the condition is that the STT is paid on the transfer. Then what is the tax rate which they are saying? Here, if the transfer takes place before 23rd July 24, the tax rate used to be 15%. Right? So the tax used to be 15%. Now, on or after 23rd July 24, the tax rate is increased to 20%. So the tax rate is increased to the 20%. In the long term, the tax rate is reduced, whereas in the short term, the tax rate is increased. Are we clear? Here also there is one exemption, that if the STT is not paid on transfer, what is that exemption which is one given? Where the transactions have taken place on the recognized stock exchange in the IFSC and the consideration which is there is paid in the foreign currency. In that particular case, even if the STT is not paid on the transfer, that is still considered fine. You are still covered by the 111. Are we clear? So just write down exception. Give me a minute. Give me a minute. I think there's my system has hanged. Yeah. I hope the screen is visible to everybody.
Yes, ma'am.
Okay. So we were writing here this point that there is this exception in the case of the where the STT is not paid on the transfer. think there's still some problem. Yeah. Is the screen visible now? Okay. Yeah. So basically, you can just write down that in the case where STT is paid at the time of transfer, so STT is not paid at the time of transfer, in the case where the transactions are listed on a recognized stock exchange in IFSC. I think I am only not able to see my screen. Hmm. Right, so this is my exception. Here also, in case there is a resident individual or HUF, in that case, you will get the unutilized basic exemption limit. So you will get the unutilized basic exemption limit here as well in case the resident individual or HUF is there. So similarly, what example we have done here also, it will be the same thing. So you can just write down resident individual or HUF and claim unutilized basic exemption limit. Fine.
Ma'am,
Yeah,
what you are writing is not visible. Now
it is visible. I think there is some delay in my system is not responding well. I'll just restart during the break. So till then I will just request there may be some delay what I'm writing and then you are able to see later maybe.
okay.
Yeah. Is it visible now? I think I will. Ashok ji? Ashok ji? Give me a minute, please. Yeah, I hope now it should be fine.
Yes, ma'am. Now it is.
Yeah.
Yes, ma'am.
Fine. Okay. So this is what is again 111A, which is the short-term capital gain, right? And now the tax rate is increased to the 20%. Fine. And other than the 111A, what will be the tax rate on other than 111A? Yes, students, what will be the tax rate on other than 111A? Faster?
General rate that is 15%.
Where is 15%? Where does 15% come from? What will be the tax rate? It will be taxed at the normal rate of tax. It will be taxed at the normal rate of tax, isn't it? So other than 112A, 111A, everything else will be taxed as per the normal rates of tax which are applicable to the particular. Are we clear? Yes or no? Any questions, any doubt with respect to the tax rate? Yes.
Ma'am, normal tax rate means slab rate?
Yes, for individual and HUF, it is going to be the slab rate. For the companies, it is going to be the applicable tax rate. For the partnership, it is again going to be the applicable tax rate, what is applicable to them.
Yeah, okay, ma'am.
Okay. Now, next few points, we are going to directly do it from the module. We are done with the tax rates. Now we are just done with remaining with 54 series exemption and some part of the computation which is concerning 50C, which is something we can just quickly do it from the module itself. Let me just open up the module for you. अशोक जी, I think we should it's because I think I'll have to restart my system. It's hanging a lot. मुझे रीस्टार्ट करना पड़ेगा बिकॉज कुछ चल ही नहीं रहा है उसमें, फाइल हो रही है, बहुत हैंग हो रहा है। हाँ, आप 5 मिनट या 10 मिनट का एक ब्रेक दे दीजिए, मैं एक रीस्टार्ट कर लेती हूँ पीसी, और फिर बाद में हम एक भी ब्रेक नहीं देंगे, डायरेक्टली जस्ट प्रोसीड है। पूरा सिस्टम ही हैंग Okay, so let's just quickly discuss about the 54 series. Now, under the capital gain, you get a lot of exemptions if you invest in the specified asset. So we are going to deal with, you have already done this as a part of your IPCC also, and this is something which is again you are now having as a part of your computation year as well. So it's very important to remember these particular provisions. So first is section 54 here, which is a specified asset which is to be transferred. It's a residential house. So you have to transfer the specified asset, or let me just make a small summary for you simultaneously. Yes. Okay. So are you able to see the screen? Yes. So just write down exemption under section 54. So which is a specified asset first, or you can just write here asset to be transferred. This will help you for your exam revision also. This is for 54. It's a residential house. Okay. So my asset to be transferred under 54 should be a residential house, which should be a long-term capital asset. Right? It should be a long-term capital asset. It cannot be a short-term capital asset. Now, which is an asset that I have to purchase? So I have to invest this amount into another residential house. I have to invest into the amount in another residential house. So asset to be purchased here, so capital asset to be transferred is the residential house property, and the specified asset to be purchased is again a residential house property on the students. So asset to be purchased is residential house property. Now here there are 2 points. One is if the capital gain which is arising is lesser than rupees 2 crores. If my capital gain is lesser than rupees 2 crore, or if my capital gain exceeds rupees 2 crore, less than equal to rupees 2 crore. Now if I have the capital gain lesser than rupees 2 crore, then I have an option. The assessee has an option to purchase 2 residential houses in India or construct 2 residential houses in India. Are we clear? So this is a once in a lifetime option which is available to the assessee to invest the amount either on the purchase of 2 residential house or construction of 2 residential house. So if, let's say, for example, I have sold a house in, let's say, Mumbai, I can purchase, if my capital gain is lesser than 2 crores, I can invest this amount. Let's say I will purchase 1 CR of house in, let's say, Mumbai, and another 1 CR in, let's say, Pune. But once I exercise this option in this previous year, and again in, say, let's year, I will, in the next year, I will, let's say, selling the Jaipur house. Oh, sorry, Pune house. Right? Then again, I cannot have an option to invest the amount in 2 residential houses. Even though my capital gain will be less than 2 crores. Are we getting it? So this is a once in a lifetime opportunity which is available to the assessee. So just write down over here. If the capital gain is lesser than 2 crore, assessee has option to purchase or construct 2 residential house plots. But remember, this is once in a lifetime option. So once exercised, again, option is not up. If my capital gain is more than 2 crore, then I can just invest in one residential house. What is the time limit of investing? There is a time limit to invest. So what is the time limit under 54 series? So under 54, it is 1 year before or 2 years after the transfer in case I have to purchase. If I have to construct, it is within 3 years after the date of the transfer. Are we clear? And this has to be a residential house in India. This is in India. You cannot purchase outside India. The time limit to investors for the purchase in both the cases, it is 1 year prior to transfer or 2 years post transfer. And if it is construction, then it is 3 years from transfer. Clear? So this is section 54 exemption. What is the quantum of exemption which is available? It is the entire amount of the long-term capital gain that you are investing or the amount of investment whichever is made. However, the maximum exemption that can be claimed under section 54 is going to be 10 crores. The maximum exemption that will be claimed will be restricted to rupees 10 crores. Are we clear? So the maximum year exemption will be restricted to 10 crores. Okay. And here the exemption amount will be to the extent of LTCG or amount invested, whichever is lower. Fine. Until the time when you file your return of income. If you file your return of income, let's say on 31st of July, and you have, let's say, only invested rupees 5 crore in the construction, then if my capital gain is, let's say, 8 crore, so 3 crores I have to deposit in the capital gain account scheme for claiming the exemption under 54. So before the due date of filing the return of income, if I have not utilized my entire long-term capital gain, I have to invest in the amount in the capital gain account scheme on or before the due date of filing the return under 139(1). Are we clear? And then only I will get the exemption. Otherwise, I will not get the exemption if I do not invest the amount. Now, what if I transfer the asset which I have purchased or constructed 3 years from the date of acquisition or construction? So, if the asset is transferred within 3 years, if asset is transferred, or you can just write here my lock-in is, you can write first the lock-in period is 3 years. If asset transferred within the lock-in period, then in that particular case, the amount or the cost of the asset will be reduced by the capital gain exempted earlier. So, in that case, you can just write down the cost of the asset will be reduced by the exemption claimed under section 50. So let's say, for example, if my LTCG was rupees, let's say 3 crores, I have invested in residential house property, let's say 2 crores. So this was my exemption under 54. Let's say I'm now selling this house or rupees, let's say 5 crores. So therefore, the capital gain on the new house will be 5 crore minus 2 crores, which is the cost of that asset, right? Out of which the cost of acquisition, out of which whatever amount I have claimed exempt. So let's say, for example, if the cost is, let's say 2 crores, then in that case, the entire amount I had claimed the exempt. So this entire amount will be now reduced. So the cost will become 0. So 2 crore minus 2 crore, the cost minus the exemption. So this entire 5 crore will be taxable. Are you getting this point? If let's say, for example, the cost was, let's say, 4 crore. My long-term capital gain entirely was exempt. Then the exemption under 54 was, let's say, rupees 3 crore, because lower of the 2 is there. So then what I would have done is I would have reduced from 4 crore minus 3 crore. So in that case, 4 crore would have been taxable. 5 crore minus 1 crore. Are you getting this point, students? So if I transfer the asset within the lock-in period, the capital gain which is exempted earlier, the exemption amount will be reduced from the cost of acquisition. Yes or no? Any questions, any doubts so far? Yes? Is this clear? Yes or no, students? Faster, please. Fine? So this is, yes.
In last, what you have done this 5 crore slab.
Yeah. So I have given two examples basically over here. In the first example, I have considered that the cost of the asset was 2 crore. So the entire cost of the asset was claimed as exemption under 54, because you have to claim the lower of the two. 3 crores or 2 crores, whichever is lower. So if I have claimed 2 crore as the exemption from the cost, I will reduce the 2 crore, which will make the cost 0 only, right? Now, then I'm assuming that, let's say, the cost of the asset is 4 crores. Now, 3 crore or 4 crore, whatever is lower, 3 crore is lower. So the exemption under 54 will be 3 crores. Now, when I will sell the house for 5 crore, out of 4 crore, I will reduce the 3 crore, which I have claimed exempt earlier. So now the cost is 4 CR. Earlier, the cost was 2 CR. So 4 crore minus the LTCG exempt earlier is 3 crore. So 1 crore will be reduced from 5 crore, which will make the capital gain on new house 4 crore. Is this understood?
Yes, clear. Thank you.
Yeah. Okay. So all of you are clear with respect to 54? Now the next one which is there is again in terms of the capital asset, the exemptions that we have to claim, right? So write down just again here. Let me again, I think module has stopped sharing. Yeah. So if you see, with respect to the 54, we have to claim the entire capital gain or the amount which is invested, whichever is lower. Are we clear? Now next one is 54B, which is capital gain on transfer of the agricultural land. The earlier one, every assessee was covered or only the individual or HUF was covered. Here in 54, only the individual and HUF is covered. So you have to just write down this point also. Under 54, the assessee, eligible assessee, also you have to write down this point. Individual or HUF. Next one is 54B. Again, you have individual or HUF. The asset to be transferred is the agricultural land under 54B. Now, when you transfer the agricultural land, right, whether first of all there is a capital gain implication on the agricultural land. So, which agricultural land are they referring over here? Yes. Which agricultural land are they referring over here? Yes, students, faster.
Rural agricultural land.
How rural? Rural is exempt, right? So how can the capital gain arise on the rural?
Yes, ma'am.
So which agricultural land are we referring? Urban. Yes, Kirti. So Kirti, Harshad, Tariq, I think I'll request you to please join on the Zoom so that you can participate more efficiently through the Zoom instead of the query link. Yes, Kirti. It is right. It is urban agricultural land. So here the agricultural land which is referred to is the urban because the rural agricultural land is the exempt. The rural agricultural land is an exempt, right? So therefore, give me a minute in this. Yeah, urban agricultural land. Now, when you transfer the urban agricultural land, only then you will be able to claim students the exemption, right? Now, such land must have been used for the agricultural purposes by either the assessee himself or his parents or by the HUF in case of HUF in the 2 years immediately preceding the date of the transfer. So, used by assessee or parents 2 years before the transfer for agri purposes. Now, what is the asset to be purchased? It says that he should purchase another agricultural land, which could be urban or rural. So, another agricultural land to be purchased, which can now be either urban or the rural. So, the agricultural land to be sold is the urban. The agricultural land to be purchased is urban or rural. What is the time limit? 2 years from the date of transfer. So the time limit to invest is 2 years. Are we clear? Is there any criteria for the maximum investment? The answer is no. There's no criteria for the maximum investment, just like we had 10 crore in 54. Here what they say is that whatever the cost you are investing, either that amount or the capital gain, whichever is lower, will be exempt. Are we clear? And what is the lock-in period over here? So here you can just write LP capital gain or amount invested, whichever is lower. Here they do not say whether it is a long-term or whether it should be a short-term capital asset. They do not say anything like that. It does just they say that it should be an urban agricultural land. It can be long-term, it can be short-term. Here the lock-in period is 3 years. If you transfer the agricultural land, new agricultural land before the 3 years from the date of acquisition, again, the cost of the land will be reduced by the capital gain exempted earlier. Are we clear? So in this case also we will do the same thing. So again the lock-in is 3 years and the cost of asset will be reduced by the capital gain exempted earlier. So if you can see the example over here, they are saying that if let's say for example new agricultural land is sold for 6 lakh rupees, then in that particular case 6 lakh rupees minus the cost of acquisition which was the 4 lakh rupees. So here they have said that if the capital gain is, let's say if the new cost of the new agricultural land is 4 lakh and the capital gain exempted earlier was 3 lakh, so out of 4 lakh you will reduce the 3 lakh and then 1 lakh only you will reduce from the cost. 1 lakh you will reduce from the sale consideration. So 5 lakh will be chargeable to tax as the short-term capital gain. Are we clear? Next is 54D, which is again on the compulsory acquisition of land and building of an industrial undertaking. So next one is 54D, which is compulsory acquisition of the industrial undertaking. Which section do you remember on the compulsory acquisition? Yes. Here it is not only individual or SQF but any associate, because industrial undertaking can also be owned by a corporate. Which section do we remember on the compulsory acquisition? Yes, faster. Which asset? Which section? Yes. Yes, yes, faster. Section 45(5) is applicable on the compulsory acquisition, isn't it? Students, you're forgetting. You have to keep revising. So what is the asset to be purchased? Any land or building, you can again purchase it for the purpose of shifting from the existing industrial undertaking. But the earlier industrial undertaking, the land and building should have been used for the purpose of the business of industrial undertaking in the 2 years preceding the date of transfer. So this land or building, this should have been used for 2 years for the business, right? What is the again time limit to invest? 3 years. The time limit to invest is 3 years, and within the 3 years, you have to invest that amount. What is the quantum of exemption? The capital gain or the cost of the new asset, whichever is lesser. What is the lock-in period? So, this I am writing here like this. It means same. Lock-in period is 3 years. Again, this is applicable on long-term, short-term capital asset both. Right? It is applicable on the long-term, short-term capital asset both. What if the asset is transferred within the period of 3 years? If the new asset is transferred before 3 years from the date of purchase, again the cost of asset will be reduced by the capital gain exempted earlier. So, are we clear? So, this is 54D. Next one is 54EC. 54EC is applicable again to any assessment. What is the asset to be transferred in the 54EC? It should be a long-term capital asset, being land or building or both. So, not the residential house property, it can be any land or building or under 54, it is residential house property. Under 54 EC, it is land or building or both, and it should be a long-term capital asset. Are we getting it? See here under 54B, it can be short-term or long-term. Similarly, under 54D, also it was short-term or long-term. But under 54 EC, it is only a long-term. What is the specified asset to be purchased? Bonds. So NHAI bonds, RECL bonds. Under these bonds, you should make the investment. Are we getting it? So the investment has to be made in the RECL or NHAI bonds. What is the time limit to invest? It is 6 months from the date of transfer. So the time limit is 6 months from the date of transfer. If you remember, we have done certain CBDT circulars where it has been clarified that on conversion of the capital asset into stock in trade, the 6 months will be counted from the date when the stock in trade is sold and not from the date when the capital asset is converted into stock in trade. Even in case of the compulsory acquisition of land, 6 months will be computed from the date when you receive the compensation and not from the date when it is compulsorily acquired. Are we clear? So we have already done that, right? So 6 months is to be considered from the date of transfer. You can just write here the references for that. For conversion of the capital asset into stock in trade from date of stock sale. For compulsory acquisition from date of compensation receipt. Right? This we have already done. Now here I would like to discuss one more case law. So in case of depreciable asset, whether you can claim 54 EC, can you claim 54 EC in case of depreciable asset? Yash, what is the rate of taxation for short-term urban land? It is the normal rate of tax. Only for the equity shares, units of equity-oriented mutual funds or business trust, you have the 111A. Other than that, it's the normal rates of tax. Okay? Yes, student. Whether in depreciable asset, can you claim 50? Yes or no? Can we claim 54 EC?
Ma'am, in depreciable asset, it is deemed short-term capital gain, na?
Correct. In depreciable asset, it is deemed to be the short-term capital gain, right? So, are we saying we cannot claim 54 EC? Mansha, Yash, Kirti, I would request you if you can, join through the Zoom because then you will be able to interact much better. Yes. So, 54 EC, Mansha, you are saying we can claim it? Yes. So, see, even though the gain is deemed to be, as you Ginny rightly pointed out, deemed to be a short-term capital gain. But it is possible that if the asset is held for more than 24 months, the gain is deemed to be short-term capital gain. But it doesn't become that the asset is also a short-term capital asset. A depreciable asset, which is a building, right? A building which is a depreciable asset can be a long-term capital asset if it is held for more than 24 months. Isn't it? The gain is deemed to be a short-term capital gain. The section 50 does not say that the capital asset is deemed to be a short-term capital asset. It says that the gain arising from the depreciable asset will be deemed to be a short-term capital gain. But the asset can remain as a long-term capital asset. So when it comes to a building, which is a depreciable asset, yes, Harshad, you are right. We can claim the 54 EC exemption. This has been upheld by the court in the VS Dempo case. Okay, so just write down the Supreme Court has upheld this particular point in the Dempo company case. So you can just write over here. In case of building, if it is a depreciable asset, 54 EC can be claimed, which is upheld by Dempo Supreme. Are we clear? Yes. So 54 EC we can claim in the case of the depreciable asset. Clear? Now, what is the lock-in period over here? 5 years. The assessee should not redeem the bonds, should not transfer the bonds, or also avail any loan on the bonds for the period of 5 years. So you can just write over here, the lock-in period is, it's not 3 years unlike others, it is going to be 5 years. So no transfer, redemption or loan on the bonds. Avail the loan on bonds. Here, what is the exemption which is given? The capital gain or the amount invested, whichever is lower. But here there is a ceiling on the investment, which is maximum 50 lakh. So here, the maximum investment that you can make is, the exemption will be the capital gain or the invested amount, whichever is lower, but the maximum investment can be rupees 50 lakh or maximum exemption can be 50 lakh. Okay. Now, what if you transfer these bonds or avail the loan on these bonds within 5 years? So then, unlike 54 to 54D that you have seen, where from the cost of the new asset, we were reducing the amount exempted earlier. Here, you don't have to do like that. Here, automatically, what will happen is, students, the amount exempted earlier will be charged to tax as the long-term capital gain in the year of violation of the condition. Okay. So here, if you transfer within the lock-in period, so then amount of exemption shall be deemed to be long-term capital gain in the year of violation. Are we clear, students? So this is 54E. Next is 54F. Now what is 54F? Under 54F, who is the eligible assessee? Again, only individual or HUF. What is the asset which is to be transferred under 54F? The asset to be transferred is a long-term capital asset, not being a residential house. So it has to be again a long-term capital asset, not being a residential house. So can a land be covered under this? Yes. Land can be covered because land per se is not a residential house. So under 54, you have a residential house. Here you have just, here maybe any other asset other than residential house, but it could include a plot of land also. What is the asset that you have to purchase? You can purchase a residential house in India. What is the specified asset that you have to purchase? It is the one residential house in India. Either you can purchase or you can construct a house. So, what is the asset here? Purchase or the construction of the residential house property, but only one. Under 54, you had the option to do with the two houses if the capital gain was less than 2 crore. Here, nothing like that. Here, what will be my time period to invest in the house property? For the purchase, 1 year before, 2 years after. For the construction, within the 3 years after the date of transfer. So, same like 54. So, the time limit is for the purchase 1 year prior or 2 years after. For the construction, it is 3 years after the date of transfer. Now, what is the exemption over here? Here, the exemption is different. So, what is the quantum of exemption? the quantum of exemption if the cost of the residential house is more than my sale consideration. Then the entire capital gain is exempt. But where the cost of the residential house is less than the net sale consideration, then only the proportionate amount is exempt. So if cost of the residential house property is greater than the sale consideration, entire capital, where the cost of the residential house property is less than the sale consideration, then the exemption will be LTCG into the amount of LTCG into the amount of the new residential house property, or you can just write the cost of residential house property divided by net sale consideration. So this is the amount of investment. But the maximum investment which can be made will not exceed 10 crores. So the maximum investment shall be rupees 10 crores. Are we clear? Now, what is the condition over here? There are certain conditions over here. So, here they have, first of all, again, a lock-in window which is applicable in terms of the number of houses that you have. So, what they say is that the assessee should not own more than one residential house property on the date of transfer. So at the moment when you are purchasing another house, you should only have one house property with you. And the assessee should not purchase any other residential house within a period of 2 years or construct any other residential house within the period of 3 years from the date of the transfer. Are you getting this particular point? And you should not be transferring this house within the period of 3 years. If you transfer the new house within the period of 3 years from the date of purchase or construction, then the capital gain which will be arising on the transfer of the new house and the capital gain which is exempted earlier under 54F would be taxable as the long-term capital gain. Are we getting this? And in case you purchase any other residential house within 3 years or construct any other house within 3 years, then the capital gain exempted earlier would be deemed to be the long-term capital gain and chargeable to tax in the year in which the residential house is purchased or constructed. So write down here the lock-in is 3 years, right? So first of all, if the new house is transferred within 3 years, then the capital gain on new house and the exemption claimed earlier under 54F shall be long-term capital. Are we getting this particular point? Yes. And in case, what are the additional conditions? On the date of transfer of the asset, assessee should not own more than one residential house property. If assessee has two houses at the time of transferring the original asset, he will not be able to claim 54F. The assessee should not purchase another residential house property within 2 years or construct the residential house property within 3 years from acquiring the new house. If this condition is violated, then capital gain exempted under section 54F will be considered as the long-term capital gain chargeable tax in the previous year in which new residential house property is purchased or constructed. Yes, students, any question, any doubt with respect to 54F? Yes or no? Yes, any question, any doubt that you have? All of you are clear with 54F? Yes or no? Faster, please give me the answers. Are we clear with 54F? If you have any questions, please feel free to ask me. Okay, so there are these conditions that the assessee should not be owning more than one residential house property on the transfer of the original asset. If that be the case, you cannot claim the 54F. And secondly, you should not be purchasing within 2 years from the date of transfer of the original asset or construct within the period of 3 years after the date such as transfer of such asset any residential house other than the new asset that you have. So sorry, this would be 2 years from the date of transfer, not from acquiring the new house. From the date of transfer of original asset. So these two additional conditions are to be respected. So where if you transfer the new asset within the 3 years from the date of its purchase or the construction, then the capital gain which is arising from the transfer of the new capital asset which is there, as well as the capital gain which is exempted earlier, shall be deemed to be the long-term capital gain in the year in which the new asset is transferred. Are we clear? Yes or no? And in case where you purchase a new house, let's say you purchase the new house or you construct the new house within that 2-year or 3-year window earlier, which is given, then in that particular case, again, it will be deemed to be the long-term capital gain in the year in which the condition is violated. Are we clear? Yes or no? Any questions, any doubt so far? Fine. Is this clear? Okay. Now the last 2 points under 54 is with respect to the 54G and 54GA. Now what is 54G? So 54G is again the exemption that we'll see it from the module itself. Exemption of capital gain for shifting of industrial undertaking from urban areas. See, 54D was with respect to the compulsory acquisition of land in an industrial undertaking. This is shifting of industrial undertaking from the urban area to any other area, which is basically a rural area. Eligible assessee is any assessee. There should be a transfer of plant, machinery, building or land or any right in the land or building which is used for the business of the industrial undertaking. In 54D, it was only land or building. Here it is machinery, plant, building or land. And this transfer is happening because the industrial undertaking unit is being shifted from urban area to the rural area. So what is the asset to be purchased? New plant and machinery for the purpose of business, new land or building or construction of the building, right? And any other expenses which are incurred for that. So that is the eligible asset and it has to be done within 1 year before or 3 years after the date of transfer. What is the exemption? If the cost of the new assets exceed the capital gain, then entire capital gain. So basically the capital gain or the cost of assets, whichever is lower. This is applicable to short-term, long-term both. The lock-in is 3 years. If the asset is transferred within the 3 years period from its date of purchase or construction, then the capital gain exempted earlier under 54G would be reduced from the cost of the new asset for the purpose of calculating capital. Are we clear? Then last one is 54GA, which is exemption of capital gain in certain cases on transfer of capital asset in case of shifting of industrial undertaking from urban area to SEZ. Again, here any assessee is covered. The transfer should be of the capital asset in the course of shifting of the undertaking. What should be purchased? The assessee should purchase any plant or machinery, land or building or any expenses for that within a period of 1 year before or 3 years after. And again here it is the same thing. The exemption will be the capital gain or the cost of the asset, whichever is lower. Lock-in is 3 years, and in case you transfer within the lock-in, then from the cost of the new asset you will reduce the capital gain exempted earlier. Is this clear? And in case there is pending utilization, you can deposit the amount in the capital gain account scheme. But this is to be utilized within the stipulated time of the 2 or 3 year window which is here. Yes or no? In case you do not utilize the amount in the capital gain account scheme, which is lying unutilized, that amount will be chargeable to tax within the when the specified period will expire, and that will be taxable in that year. Yes, is this clear? Any questions so far? Now the last portion which is remaining is with respect to the section 50C and 50CA of the Income Tax Act. If you see, I had told you in case of sale consideration, what is the full value of consideration that I take? The amount which is accruing to me, right? But in case of certain assets, we have the different sale consideration which is prescribed, right? In some cases, you take the FMV. In some cases, there is a specific section 50C or 50CA which becomes applicable. So first of all, what is section 50C? So 50C is applicable on the, you can just write down section 50C. Now what is 50C applicable on? This is on the land or building, right? So what do they say is, in case of the transfer of the land or building, in case of the transfer of the land or building, if the stamp duty value exceeds 110% of the consideration received. In case, you have to ask a question whether the SDV is greater than 110% of the sale consideration. If the answer is yes, then my full value of consideration is the SDV. If the answer is no, then my full value of consideration is the actual sale consideration. So basically, the difference between the SDV and the sale consideration should not be more than 10% of the sale consideration. Now, on which date you will take the SDV? So for that purpose, you have to see is to be taken as on the date of the registration of agreement or as on the date of the transfer of the property. Now, it is possible that the date of agreement, when you sign the agreement, may be different from the date when you register with the stamp duty authorities. Right? So in that particular case, you have to see whether you have received any consideration by way of the account pay check, ECS or bank draft or electronic mode on or before the date of agreement. So you have to check whether you have received the sale consideration. It may be wholly, it may be partly. Whether you have received any amount, not in cash, students. Be aware about that. You should be receiving the amount by the account pay check or bank draft or the electronic mode. If that be the case, then you have to take the SDV on the date of agreement. So you have to check if the date of agreement is different from the date of registration. So SDV, whether date of agreement is different from date of the registration. Right? If the answer is yes, then in that particular case, you have to see whether consideration is received on or before the date of agreement through account pay check or electronic mode. Right? If the answer is yes, in case you have received the amount on or before the date of the agreement by way of the account pay check or bank draft or electronic mode, then you have to take the SDV on the date of agreement. If the answer is no, then you have to take the SDV as on the date of registration. Are we clear? So just write down. And just write here. Yes, SDV on date of the agreement. If the answer is no, then SDV on date of registration. So if you see in your module, certain examples are also given for this. So let's say, for example, if the actual sale consideration is 100 lakh, stamp duty on the date of agreement is 109 lakh, and stamp duty value on the date of transfer is 112 lakh. If the part of the consideration is paid by prescribed electronic mode on or before the date of agreement, then the actual sale consideration would be 100 lakh, would be full value of consideration, since the stamp duty value of 109 lakh on the date of agreement does not exceed 110% of actual sale consideration. So you have considered the date of agreement over here and not the date of registration, because the consideration is paid before the date of agreement. If no consideration is paid by the electronic mode on or before the date of agreement, then the stamp duty value as on the date of registration will be taken, which is 112 lakh. And since it exceeds 110% of 100 lakh, you will consider that as the SDV, and then 50C will be added. Are we clear? Yes. Now there is a possibility that where the assessing officer may make a reference to the valuation officer, because the assessee disputes the claim that the stamp duty value is more than the fair market value of the property. So what happens sometimes is that sometimes the 50C valuation, the stamp duty valuation which is there, appears to be more than the actual value of the property, the fair market value of the property. Because, sometimes there are some, kind of properties which are lying vacant. There are certain properties where the resale itself is very difficult. Nobody is there to ready to purchase. There are some kind of properties which are lying vacant for a long time. There's something would have happened there. Nobody is there to purchase. And then suddenly you get some buyer. So the fair market value obviously decreases, but the stamp duty value would be the actual value on which the stamp duty is being levied, which is a ready reckoner value or a circle rate. So the assessee can debate or dispute that this is not the actual value or the fair market value. The stamp duty value, what the assessing officer is saying, is not the fair market value of the property. So he can make a reference to the assessing officer, and then assessing officer can refer to the valuation officer. So where the assessee disputes that, then in case if the valuation which is adopted by the valuation officer is, let's say, more than the stamp duty value, we'll take the stamp duty value. If the valuation officer says that the value is lesser than the stamp duty value, then you will adopt the valuation by the valuation officer. Are we clear? Then coming to the 50CA. 50CA is applicable on the unquoted shares. 50CA is applicable on the unquoted shares. Unquoted shares meaning the shares which are not listed on the recognized stock exchange. So in case of unquoted shares, you have to substitute the sale consideration with the FMV of such shares, which is determined as per Rule 11UA. Which is determined as per Rule 11UA. So in case of unquoted shares, we adopt the Rule 11UA FMV. Are we clear? Then the last section is section 51, which is advance money received in case it is forfeited. It is possible that you give the advances for the property, right? But sometimes the negotiations are happening with respect to the pricing, and then the transfer may not really take place because you do not want to go ahead with the deal. Then the seller may just forfeit that advancement, right? So till 2014, this used to be reduced from the cost of acquisition. This used to be reduced from the cost of acquisition, and now it is taxable under 5629. If the advance money was received and forfeited after 2014, this is to be reduced. This is to be considered as the income under income from other sources. In the year of forfeiture, before 2014, is used to be reduced from the cost of acquisition. Right? So this is the last section. Now I will just quickly go through certain case laws on this particular point on the capital gain. So which are again more so to deal with the 54 exemptions itself. Now what are these cases? Let us try and understand. So let's say, for example, there was a case before the Supreme Court that can the advance which is given for the purchase of land, building, plant and machinery, right, whether that can be considered to be eligible for exemption under 54G. What is 54G for? 54G was shifting of undertaking from the urban area to shifting of industrial undertaking from urban area to the rural area. Now, where as a part of investing the amount under 54G, I give an advance, whether advance can be considered for exemption. So the Supreme Court has held that in order to invest the capital gains for the purpose of acquiring the new machinery or land or building, I can give an advance to the seller from whom I am going to purchase the new asset. It is not that if I have given the advance, that is something which is not to be considered as the utilization of the capital. I can give an advance. So advances will also be considered as the utilization of capital gain because advance is given for the purchase of the new asset. So that is fine. That is not a problem. I can give the advance for purchasing the new asset. Are we clear? Then next particular case is with respect to the section 54. Now, in a case where, for example, I have invested in a house, but this house that I have constructed or I have purchased are two adjacent flats where I have broken the wall in between. I have made them as a one house. General practice where the families are big, there are joint families. We just, break the wall in between of the two houses. We purchase the two adjacent house and we make them as a one flat. And the entry will be, let's say, one. Right? So whether we will consider this as one house property or whether we will consider this as a two house property. So various courts have held that where two flats are purchased which are adjacent to each other, but the entry is common because the wall is broken in between, will be considered as one single residential unit. And the assessee will be entitled to claim the exemption under 54. Or for that matter, even under 54F. Because for 54 or 54F, if the capital gain is lesser than 2 crore under 54, if the capital gain is more than 2 crore under 54, you are allowed to invest only in one residential house property. Even under 54F, you are allowed to invest only in one residential house property. But where you have purchased two flats which have a common meeting point, the section 54 or 54F says that it should be one residential unit. And these two adjacent houses which have one common meeting point will be considered as a single unit. And this will be eligible for exemption under 54 or 55. Are we clear? Yes or no? Any questions so far? What if I have purchased the house in the name of my wife or in the name of my husband? Then in that particular case, whether I can claim the exemption under 54 or 54F? Yes. Or it is purchased in the joint name. Can the exemption be allowed to me if I am paying for that house? Yes or no? So when you purchase in the name of your spouse or you purchase in a joint name, it is to be seen that who is paying for the house, who is utilizing the capital gain for the investment in the residential house. Doesn't matter in whose name it is. It can be entirely in the name of my spouse. Doesn't matter. It can be in joint name. It's a common practice that you see. Both husband and wife, mother and son will purchase the house jointly. Or I may, just purchase the house in the name of my mother. But it is me who is actually utilizing my capital gain into the investment into that house. So the condition is that the house should be purchased by the assessee. The condition is not that the house should be in the name of the assessee. The house can be in anybody's name. It can be in the joint name. I will be entitled to the exemption for that. Are we clear? Yes or no? What if I have invested in the house, but the construction is not completed in entirety? I have not got the possession of the house. Because, some electrical fitting work is pending, some painting work is pending, some fittings of the door are pending. And 3 years have passed by. Whether I will be entitled to claim the exemption under 54F or 54? Yes. It is just that I have not received the possession. The construction is complete. It is just that I have not received the possession of the house. It doesn't mean that I have not invested the amount in the construction of the house within the stipulated period. It is just that some little bit work is pending, because of which I have not been able to receive the possession of the house. That is fine. That is fine. That is entirely fine. I will still be entitled to the exemption. Are we clear? What if in a case where under 54F, what is the amount of exemption that you claim? The exemption is the long-term capital gain into the amount invested divided by the net sale consideration. Right? Now, in case this net sale consideration which is there, let's say here this is adopted as the stamp duty value. So then in respect of claiming the exemption, while claiming the exemption under 54F, will I take the actual sale consideration or will I take the value as per the stamp duty valuation if I have considered that as the sale consideration? Let's say, for example, if my actual sale consideration is 40 lakh, stamp duty value is 50 lakh, and I have taken the stamp duty value because it exceeds 110% of my sale consideration. Now, if let's say my capital gain was 12 lakh, then exemption under 54F will be 12 lakh into the amount invested divided by 50 lakh or divided by 40 lakh. Are you getting the question? So, when I consider the sale consideration as the stamp duty value, what will be the denominator over here? Yes? The question is to you. Yes, please. Whether you will consider here 50 lakh or 40 lakhs. So let's say, for example, here, let's say my sale consideration is 40, SDV is 50, so my FVC becomes 50. Let's say my LTCG is 12 lakh, and let's say amount invested is in new house is, let's say, 47 lakh. So I will do 12 lakh into 47 lakh divided by 50 or divided by 40. Yes, students, what will I do? I will take 50 lakhs and not 40 lakhs. So here I will take 50 lakh and not 40 lakh. So here the net sale consideration will be adopted as the SDV. Are we clear? Yes or no? So for respect of the 54F, you will take the consideration which is the as per the stamp duty valuation. Are we clear about this? Yes or no? Is capital gain entire chapter clear to you? Yes, students. Any questions so far? Yes. Yes. All of you, shall we move to the next chapter? Mansha, you don't have to consider the tribunal rulings. Only the High Court and the Supreme Court judgments are applicable. Are we clear? Yes, students. Yes or no? Any questions so far? Okay. So let's then move towards the next topic, which is the income from other sources. So just write down. because we are done with the capital gain, and now the last topic is the income from other sources. So income from other sources is the residuary head of income, right? Isn't it? So whatever is not chargeable under section 50, under section 14 to 54 will get chargeable under the income from other sources. This is a residuary head of income, right? But still, students, you have to remember, it's not that any income which is not chargeable should be chargeable under income from other sources. That has to be, first of all, an income. It has to fall within the definition of income. Will the capital receipts be chargeable under income from other source? Yes or no? Will the capital receipts be chargeable under income from other sources? Yes, students. Capital receipts, are they taxable? Yes. Capital receipts are taxable, Kirti? Yes, others, what do you think, whether capital receipts are taxable or not? Yes. You have done the difference between, what are the capital receipts? What is the difference between a capital receipt and a revenue receipt? Yes. Capital receipts are not chargeable to tax, students. They will not be chargeable under income from other sources. Capital receipts are not taxable unless specifically charged to tax. Right? These are one of the kind receipts. These are not routine or regular receipts. So these will not be chargeable to tax under income from other source because this is not in the nature of income. So unless specifically charged to tax, so if you see the capital receipts which are specifically charged to tax under the capital gains or under, for example, PGBP, for example, non-compete fee, transfer of a asset which is used for specified business, isn't it? The payment for termination of agency under the business, perquisite taxation under section 17. These are specified capital receipts which are chargeable to tax. The capital receipts which are not chargeable to tax cannot be charged under income from other source. So only there, if there is an income, then only you will go to income from other source if you cannot fit it either under salary, house property, PGBP or capital gain. So first of all, the condition is that it has to be an income. If it is not income, it will not go in the other source. Okay. So therefore, you will not charge any receipt which is not an income into the income from other source unless it fits into the nature of income, students. Are we clear? Now, just like every other head of income, here also we have the specific charge and the general charge. Under income from other sources, you also have a charging section. Just like there was a charging section under capital gain, 45, which was a general charge, 45.1, and then 45.2 to 45.6, we had the special charge. Here also we have a general charging section, which says that any income which is not chargeable to tax under any other head. So as I said, first of all, it has to be income. So if I take you to the Income Tax Act, 56 says income of every kind which is not to be excluded from the total income shall be chargeable to income tax under the head E4 if it is not chargeable to income tax under any of the heads specified in section 4. So this is the general charge which is there. So any income which is not chargeable under Any other head will be chargeable over here under the income from other sources. But as I said, first of all, it has to be the income. So just write down over here. Section 56. First one is the general charge. Section 56(1). Income of every kind, not excluded from total income and not chargeable to any other head of income shall be chargeable under the income from other sources. So this is a general charge. Then 56(2), it's a specific charge. It says in particular and without prejudice to the generality of the provisions of subsection 1. So in particular, these set of income and notwithstanding or without prejudice, whatever one says as a general provision, the following incomes shall be chargeable to income tax under EFOS. So even if you have the business of trading in shares or investing in shares, the dividend income will be specifically charged under EFOS. So even if your business is to make the investment in the equity shares or in any other shares, the dividend will be specifically charged to EFOS because this is a specific charge under 56(2). 56(2) says in particular, these set of incomes will be specifically charged to EFOS even if you have a business of investing in the shares. So the following incomes, which is a specific charge, you can just write down here. What are the incomes? First income, which is specifically covered under 56. Income specifically covered under income from other sources. You will divide again this into two parts. Income specifically charged to 52 income from other sources and income charged to income from other sources if not charged under any other head. So the first one is dividends. Are we clear? Income referred to in 224(8). Now what is 224(8)? Let's look at it. What is 224(8)? 224(8) is nothing but, this is omitted. So this is something that we don't have to look in. Okay, since this is omitted. So let's go back again to 56. Okay. Income referred to in 224(9). Or let me just open again 224 so that we don't have to go again back and forth. And then you know what is 224(9). So 224(9) again talks about that this is a specific income which is chargeable to the income tax, which is chargeable to EFOS. Any winnings from the lotteries, crossword puzzles, races, including race horses, horse races, card games, and any other games of any sort, or from gambling or betting of any form or nature whatsoever. So this is again specifically charged to tax under EFOS. So even when you have the business of playing into the horse races, still 56 says that this will be specifically taxable under income from other sources. This will be specifically taxable under income from other sources. So you can just write down casual income. Just write down over here. Casual income, which is basically income from lotteries, puzzles, and horse races. Are we clear? So this is specifically charged to tax under 56(2). Now, if you know about this kind of income, this is taxable at a flat rate of 30%. This is taxable at a flat rate of 30%. Are we clear? So you can just write down taxable at the rate of 30%. Are we clear? Now here, there is one case law that I would like to discuss over here. So there was a distributor of lottery tickets. There was a distributor of the lottery tickets. You know, there are these shops which distribute these lottery tickets. Now, there were certain unsold lottery tickets which were lying with him. And fortunately, with the God's grace, he won the money on that. There were some unsold tickets. There were some tickets which were lying with him. And one fine day, there was this lottery was announced. And he happened to see he has, won the number on that lottery. His ticket number was matching with the lottery number. Now the question was, can the winnings of these prize money on the unsold lottery tickets held by the distributor of lottery tickets will be business income or will it be income from other sources? So will this be a business income or will this be taxable under income from other sources? Yes. What do you think? Winnings on the unsold lottery tickets. Yes, please. What it would be? Other sources, Mansha? Yes. Because this is specifically charged to tax under income from other sources. So you can just write down winnings from unsold lottery tickets held by the distributor chargeable specifically under IFOS and not. Are we clear? So this will be taxable at the rate of 30% under 115BB. Now students, there is also a TDS which is applicable. There is also a TDS which is applicable on these kind of income, which is also under section 194B. So winnings from the lottery or crossword puzzle, the person who will pay for the winnings, right, or for any gambling or betting, the amount that will be paid, if it exceeds rupees 10,000, then the TDS will be deducted at the rate of 30% under 194B. So you can just write down over here, TDS under section 194B on the amount greater than rupees 10,000 in case of lottery or gambling. And there is TDS under section 194BB in case of winnings from the race horses. Again, if the amount exceeds rupees 10,000. So on the race horses, TDS is under 194BB on again amount greater than rupees 10K in case of winning from race horses. Here you can just write the name of the case law, which is in the case of Manju. In the case of Manju and Co. You can just write the name of the case, Manju and Co. This was held by the Kerala High Court. Are we clear? Yes or no? Okay. Now, next one, again, let's go back to section 56, is 22410. So what does it say? Income referred to in 22410, if such income is not chargeable to income tax under PGB. So here if you see, unlike 1B, where the income was specifically taxed under EFOS, this particular clause says that here, first of all, 22410 income will be taxable under this head if it is not taxable under PGBP. Now, what is 22410? 22410, which is there, is in respect of the sum received by the assessee from the employees as the contribution to the PF. Is this taxable under PGBP? Is this taxable under the PGBP? Yes or no? Do you get any hint what was this particular provision under PGBP? You must have already done as a part of PGBP. Let me see who remembers this. Sum received from the employees for contribution to the Provident Fund. Yes. What is the treatment of that? Under PGBP, there is a specific treatment of this. You would have done this already as a part of your PGBP chapter. Isn't it? What is the effect of this? Let me see who remembers. Section 36. Yes, 15A. Amount which is received as the employee contribution if it is deposited before the due date of fund, then only you get the deduction under 3615A. So first you add the amount as the income under 22410 and then you reduce the amount of deduction under 3615A provided you deposit the amount to the fund on or before the due date of the fund. Now do you recollect this thing? Yes or no? Yes, this was taught to you or not? So under 3615A, you add this amount first as a 22410 and then you reduce and allow the deduction under 3615. This is how you will present in the exam also. Now, if it is from the employee's contribution, this will be taxable under PGBP if you do not deposit within the due date of fund. But if you have collected this amount, let's say from the contractors, who are not your employees, who are not on your payroll, this amount will be taxable under income from other source if you have not deposited within the due date of the fund. So just write down. So here it will come on this side now. Contribution to the provident fund, right? If not deposited within due date of fund, and if not chargeable PGB, right? So then it will be chargeable under the head income from other sources. Now what is the next one? Income by way of interest on securities. If the income is not chargeable under the head PGBP. So again, interest on securities will be only charged to EFOs if not chargeable to PGB. So let's say, for example, I am into the business of investing in securities, or I am a bank, right? In that particular case, I get the securities as a pledge, right? Sometimes on the loan that I give. So I may receive the interest on that. So for them who are into the business, this will be taxable under the head business income. Isn't it? It will not be taxable under the head income from other sources. But if I have hold the securities, if I have held the securities for just earning the interest income, then it will be income from other sources. If the investment in securities is my only business, then it will be PGB. Are we clear? But if it's just, investment of the surplus funds, then it will be the income from the other sources. Are we clear? Yes. What is the next one? Income from machinery, plant or furniture belonging to the assessee and let on hire. If the income is not chargeable to income tax under the PGBP. Again, income from letting out of the plant and machinery if not chargeable to PGB. So let me give you an example to understand when it will be chargeable to PGBP and when it will be chargeable to the income from other source. So let's say, for example, if there is income from the letting out of the plant and machinery during the strike of the factory, let's say my factory is in strike, or let's say there was pandemic because of which the factories were not working. Now, since the factory has stopped for a temporary period, I thought in order to reduce the losses, let me let out the plant and machinery. Whether this will be PGBP or whether this will be income from other sources. Yes. Whether this will be PGBP or whether this will be income from other sources. There was a temporary strike in the factory was closed for a certain period. I have let out the plant and machinery of my factory to reduce my losses. Whether this will be PGBP or income from other source. Yes, students, you have to answer this question faster. Income from other source, Ginny. Why do you think? Kirti, you think PGBP? Why do you think PGBP or other sources? You have to give the reasoning for that. Others also, please participate. Yes. Why it will be PGBP? Those who think PGBP, or why it would be interest. You have to give wrong answer. That's fine. But please answer.
Ma'am, it may be it is a no the owner has given the plant and machinery on rent, and it is not is a normal operating operation income.
Okay.
यानी वो उसकी डे टू डे की इनकम से नहीं है, इसका नॉर्मल बिजनेस नहीं है ये
Okay.
इनकम रेंट देने का.
Okay. Understood. I got your point. See, it is, what is a business income? What is my business? Right? Business is basically not only what I undertake as a part of my activity. It will also include the income, which is basically to reduce the losses. So, my factory was on strike, and for a temporary period, I let out my commercial assets, my income, my business generating asset to reduce down my losses. That will be the business income. So, क्या हो रहा था? Since I was incurring the losses from business, for a temporary period, I let out the plant and machinery just so that I can reduce my loss, and this plant and machinery is nothing but my business generating asset. This plant and machinery will be my business generating asset, isn't it? So, this asset I have let down. So, I have let out to reduce the losses. So, therefore, this will be considered as my business income. So, you can just write it over here. If the plant and machinery or business assets or the commercial assets are let out to reduce the business losses for the temporary period, this will be PGP. Whereas, if let's say for example students, I have completely closed down my factory and then I'm letting out my plant and machinery, that will be income from other source. Now I have completely stalled my business activity. I've completely closed down my factory, and then if I'm letting out my plant and machinery, that would be income from other source. So if the plant and machinery is let out after the closure of business activity or the factory, it will be income from other sources. Are we clear about this, students? Yes or no? Yes? Ginny, it's okay to make the mistakes in the class so that you avoid the mistakes in the examination. It's completely fine. You should make, in fact, the mistakes. If you will not make, who else will make, right? Because you as a students are here to learn, right? So in that particular case, it will be considered as income from other source. Are we clear? Okay. What is the next particular income which is given over here? Let's look at it. Income where an assessee lets on hire machinery, plant or furniture belonging to him and also buildings. And the letting of the building is inseparable from the letting of the plant and machinery. The income from such letting, if not chargeable to income tax under PGBP. So again, it's the same thing, but it's just along with the plant and machinery, there is let out of building. So let out of plant and machinery with building if they are inseparable. Otherwise, building let out is under house property if it would have been separable. If not chargeable to GP. Okay. Next one is income referred to in 224.11. What is 224.11? Any sum received under a keyman insurance policy. If such income is not chargeable to income tax under PGBP or under the head salaries. Sum received under keyman insurance policy. If not chargeable under PGBP or the salary. So if the sum is received by the employee, then this shall be taxable under section 17 as perquisite under salary. If the sum is received by, let's say, a director of the company who is not a full-time director or employee of the company, this will be under section 28 of the Income Tax Act. So if you remember, under section 28, there was a specific provision for this. You remember that? Yes or no? So if the amount is received from the businessman or by the director, it will be under 28(6). Right? So you can just write down. This is PGBP director, or you can write the businessman. And in case sum received by, let's say, a family member of employee or the businessman, this is under 46(2). Okay, this is 17(3). Are we clear? Yes or no? Okay, what is the next one? This is 5th is not applicable because this was prior to 2006. Then 6 is before 2009, so even this is not there. 7 is before 2017, so even this is not there. Okay, so then we are directly coming to the 8, which is income by way of interest received on compensation or on enhanced compensation. If you remember, we have done this provision already as a part of capital gain, isn't it? We have already done this provision as a part of capital gain chapter. Which section was that, students? Which section was that? Yes, quickly. interest on compensation or on enhanced compensation? Which particular provision was that? Yes. 45.5. Vignesh, it was not 45.1a. 45.1a was with respect to the insurance compensation. This is interest on enhanced compensation where there is land which is compulsorily acquired. So that will be taxable specifically under income from other sources and not under capital gain. So interest on the compensation or on the enhanced compensation, right? And 145B is telling me that this has to be taxable on in the year in which it is received. So if you look at 145B3 or 145B1, it says the interest received on any compensation or on enhanced compensation shall be deemed to be the income of previous year in which it is received. So as per section 145B, taxable in the previous year of receipt. Taxable in the previous year of receipt. This we had already dealt in detail under the capital gain. Further, I had told you one more important point over there. With respect to the interest on enhanced compensation, 50% of the amount will be allowed to me as deduction under section 57, students. So 50% of the amount will be allowed to me as deduction under section 57. So if you see under the capital gain, we had done this particular point in detail, that 50% of the amount will be allowed to me as the deduction under section 57. So you can just write down over here. Again, my screen. Yeah. Yes or no? Are we clear about this? Yes. Fine. So interest on the enhanced compensation, 50% of this amount will be allowed to me as deduction. Okay. And the capital gain you will do as per the relevant provision of the capital gain under 45. So if you see, we have done this as a part of capital gain as well. 45.5 compulsory acquisition, interest on enhanced compensation. Are we clear? Okay. Now, one more important point over here. With respect to the compensation which is received, right? You have to be sure as that you tax in the year of receipt and not in the year when the land is acquired. Then, whether this interest on enhanced compensation, which is received on account of delay of the consideration, whether that will be taxable under the income from other source. So there was this one case, Mobilia Bikubai Balabhai, which is there in your module also. If you see this, here the assessee had received the interest as a part of enhanced value of land. So the assessee received lesser value of land and therefore the value of the land was increased. So because he received the lesser value, the interest was received on that short valuation which was there. It was held by Gujarat High Court in this case that this interest is nothing but the compensation only. It partakes the character of compensation and not the character of interest. And therefore, this will be taxable under the head capital gain and not under the head income from other source. Whereas if the interest is received for delay in making the payment of the compensation, that is taxable under income from other source. So you will just write it over here. Interest on short payment of compensation. This is in the nature of compensation. And this shall be taxable as capital gain. Whereas interest on delay in payment of compensation is interest taxable under head income from other sources. Are we clear? This is Movalya Bikubai Balabai. Fine? Okay. Now let's move again back to 56 and let's see what else is remaining. Yeah. Any sum which is received as an advance or otherwise in the course of negotiation for the transfer of capital asset if the sum is forfeited and the negotiations do not result in transfer of capital asset. So just now we discussed prior to 2014, it used to be reduced from cost of acquisition under 51. Post 2014, this is specifically taxable under 56 to 9. So advance money forfeited is taxable specifically under 56 to 9. Then 56 to 10 is the receipt of money, immovable property or the movable property without or for inadequate consideration. So basically I will write here for the moment gift tax under 56 to 10, which we will do in the next class. Then we have 56 to 11. Any compensation or other payment due to or received by any person by whatever name called in connection with the termination of his employment or the modification of the terms and conditions. So compensation for termination of employment or modification of the terms of the employment. Right? So, see, this is generally chargeable to tax under section 17 as profits in lieu of salary, if you remember. Profits in lieu of salary, right? So, if you remember under section 17, it is not only including from the current employer, but this also includes even from the past employer. Right, isn't it? So then how come there is something which is under 56? So if I take you to the salary section 17(3), profit in lieu of salary includes the amount of compensation due to or received by an assessee from his employer or former employer in connection with the termination of his employment or the modification of terms. Then why do we have a provision under 56? Because this is in relation to the employee. And under 56, if the family member receives it, then it will be under 56. So if the employee receives it, this is section 73. Profit in lieu of salary. Whereas if family member will receive, then there is no employer-employee relation, then it will be under 56. Are we clear? Yes or no? So see, you have to be very careful who is receiving it. Then finally, the last two provision, any sum received by a unit holder from a business trust with respect to the unit held by him. This is also we will do in the next class. So you can just write sum received by unit holder from the business trust. And the last one is sum received on the life insurance policy. Under the LIC. Okay. So with this, we will stop here for today. If you have any questions, happy to discuss. Otherwise, what we will do is in the next class, we will discuss the balance provision, which is deemed dividend and all of that. Yes, Prashant, 50C is similar to 43CA. Yes, exactly, it is similar. Mansha, it doesn't mean that you are setting off business losses from other source of income. It is just meaning that you are treating the letting out income on the plant and machinery as business income and not other sources, because there is a reduction of business loss. For that purpose, you have let out your plant and machinery. Kirti, it is not important to remember the case law, but if you can remember, it is good. You will fetch extra score for that. So at least the important case laws you should try to remember, Kirti. Any other questions, students, before we close the session? Yes or no? Okay, so if there are no questions, I will just stop here for today. I will request you to please revise the capital gain chapter specifically. In the next class, we will be doing the deemed dividend, we will be doing the gift taxation and the taxation on the units. This is a very, very important thing that we will be discussing in the next class. Thank you so much, Kirti. Yes, thank you all of you. Good night. Yes. Thank you. Good night.